Hello, everybody. Welcome to our second panel of the day, titled Taxation in the Eurozone. Thank you to Blockchain for Europe for hosting this event. We're most grateful to our partners in Brussels for inviting us to host this final session of what has been a fantastic last few days of interesting debates across the whole industry. Thank you to Robert for hosting the last panel with 4 wonderful panelists discussing all things regulation, both in the UK and across the Eurozone. For today's panel, I'm honoured to be joined by 3 distinguished guests, speakers from a variety of industry disciplines, including academia, taxation specialists, and from the policy arena. As we have seen rapid adoption of crypto assets over the last year or so, whether spurred by decentralized finance, NFTs, or celebrity tweets, policymakers have been given a mandate to protect consumer harms and protect against economic crime, started to issue guidance and, in some jurisdictions, regulations for crypto assets. It therefore naturally follows that as the industry grows and matures, taxation revenue services will look to bring crypto assets and any associated gains or losses into the scope of possible taxable events. Today, we're here to discuss existing requirements for both individuals and corporations within the Eurozone. We'll then look at any interesting jurisdictional differences that perhaps exist internationally and whether we will see any possible global harmonization. Finally, we'll look at some of the challenges facing companies operating in the space and discuss some of the areas where friction may exist, and perhaps we can suggest ways to improve the status quo. I'll introduce myself. I'm Ian Taylor. I'm honoured to host this panel. I'm the Executive Director of Crypto UK. Crypto UK is the UK's trade body advocating for the crypto and blockchain industry. Our mission is to educate and support fair, balanced and proportionate approach to regulation. So let me now bring in our panelists in alphabetical order. If I could ask Doris Cannon to introduce herself, please.
Hello, Ian. Good morning, everyone. Thank you very much for this opportunity. I'm Doris Cannon. I'm an international tax consultant in Brazil. I hold an LLM from King's College London and would like to take the opportunity to thank Professor Jonathan Schwartz and Professor Michael for indicating me to this panel. I have a background in international taxation in Big Four companies, and currently I work in the Brazilian judiciary.
Thank you very much, Doris. Next, I'll ask Dion Seymour to introduce yourself, please.
Good morning, and thank you, Ian. And certainly it's a privilege to be here on this panel, so thank you for the invite. I am the policy lead in HMRC for crypto assets, and HMRC is the UK's tax administration. And I've been involved in this role since early 2018. And Ian, as you know, HMRC has been keenly following the developments here for a number of years. And certainly we would like to present ourselves as being quite a forward-thinking tax administration in this regard.
Thank you, Dion. And then finally, Zoe Wyatt, please.
Hi, yes, likewise. Thank you for inviting me to join the panel. I'm a partner at Anderson in the UK. I specialise in corporate international tax. My clients are typically large, privately held multinational groups, and I advise them on their cross-border tax issues and supply chain structuring. I've always had a special interest in new technologies and the tax consequences, the characterization of transactions. And my work predominantly now is with blockchain companies.
Thank you, Zoe. Great. Well, let's get stuck into an interesting debate. So I'm going to pose the first question here to Dion. Anyone else, please feel free to jump in at any time with any additional comments. So let's get started with perhaps setting the scene. So Dion, in regards to the current UK and European guidance in terms of how crypto is treated for tax purposes, could you perhaps talk about what folks should be doing to ensure compliance with the current rules, and perhaps develop a brief overview as to what the expectation is from HMRC and how that is perhaps different within the Eurozone, and then also touch on, as the industry evolves, as we've seen in the last 12 to 18 months at a rapid pace, what's the current guidance around such areas as DeFi, and how you may see any different views across the Eurozone and the rest of the world?
Right, wonderful. Great question, Ian. So as a starting point, the taxation of crypto assets across Europe does show some notable differences, as I'm sure you're aware, in the approaches. The OECD released a report last year entitled Taxing Virtual Currencies, which provides an overview of those different approaches that are being taken. However, personally speaking, I actually see there's far more commonalities about approaches than there are differences. For example, 17 European, not strictly EU, but 17 European countries consider crypto to crypto, crypto to fiat, and crypto for goods and services all to be taxable events. Also, items like VAT are actually treated in a very similar way across the EU. From HMRC's perspective, we certainly want to help people get it right at the first time. Crypto assets are a complex topic and are quite different from traditional assets. I don't think any of us would disagree with that. It's also fair to say that the world of tax and technology have become joined in a very interesting way here. Now, for our perspective, HMRC, we published guidance. Actually, first guidance came out in 2014. We're updated in 2018 and 2019. And earlier this year, we released our crypto assets manual to assist customers and agents understand our view on taxation of crypto assets, but also through this, we have provided some of the most detailed guidance released by any tax administration. And our guidance also continues to demonstrates our continuing commitment to provide clarity to customers. And I think this is the important bit. It's all about education. And to help taxpayers stay compliant, I can give you the usual answer of keeping records and those type of comments, which I think are fairly pedestrian to say. My view would be that individuals actually need to review the guidance for their particular jurisdiction to confirm if their thoughts on tax actually match that of their tax administration. And that education should actually rest with tax administrations alone. And I think there's certainly a role for exchanges and other parties, such as obviously, we've spoken before about trade groups actually having a role to play for education. For example, in our jurisdiction, and I know reading tax guidance is not for everyone's idea of fun. Certainly, people who are involved in the space aren't taxpayers. To have a deep taxation knowledge. They're more interested in technology, I would say. However, if you don't read the guidance and if you don't know what your tax administration's view on it, you are only storing problems up for yourself in the future. In the UK, for example, there are a number of misconceptions that we've heard, and I am unclear where they've come from. For example, one is that it's only taxable when the transaction is from crypto to fiat, when it goes back to conventional hard cash, as in sterling. And many other jurisdictions, tax administrations, don't actually agree with that. As I mentioned earlier, 17 in Europe alone that have that as a perspective, that's a taxable event. And if you don't actually read the guidance, if you don't actually read what your tax administration says, then you're going to take some shortcuts and you're going to think that, and you're not necessarily going to understand where those kind of misconceptions are. So that's why it's crucially important that you don't rely on what you think or what you might read in Reddit threads, and it's actually best to go read the tax advice. Questions, for example, is it money as well also tends to come up. As it comes up, crypto assets, as we term it, we clearly don't see it to be money, and most jurisdictions around the world don't actually consider it to be money. So it doesn't mean that it's going to follow a money-like principle when it does come to tax. So you've really got to be aware of these differences. Now, normally, and speaking from the UK, more so than for the Eurozone. There is a duty for you to notify for your capital gains. And it's at this point where some may also fail the need to do so, because if they haven't understood those misconceptions, if they don't understand they've actually created taxable events, then they won't actually realize that they've got a duty to notify. And it does pose quite an interesting problem. Really, what we want to do is try to help educate customers so they know what they need to do, right? There will always be actors in any part of industry who don't want to play by the rules, that they want to seek to evade taxes or other hide their activities. And ideally what we can do is try to carve out those who want to play by the rules and help them play by the rules, so we can direct our attention at those who don't want to play by the rules. Now, the crypto sector, as you mentioned before, is fast developing all the time, and there's implications for all heads of tax. The tax treatment does continue to develop due to the evolving nature of crypto. And this pace of development does create a number of challenges for all tax administrations, not just the UK. And it's often stated that tax administrations are behind the times, and to an extent they may be right, but actually I would challenge anyone to say who's ahead of the time in this space. Who actually knows what's coming next? The pace of development is relentless, and DeFi is a big topic right now. And it was only this time last year, actually, though, it was really taking off. If you look at the figures for DeFi, it was only by mid-year that we were starting to see any particular volumes occurring. And the year before, it was Libra, or DM as it now is. The year before that, it was ICOs. And if the point I'm trying to make is that if we had actually tried to create new legislation for each of these events, we would be creating a level of complexity for tax that I don't think many people would actually thank us for. We would be constantly pushing new legislation through based upon these ever-changing events, which is why trying to find where the commonality, those first principles approaches, is actually probably far more useful for most individuals, rather than actually having to keep up to date with tax changing tax law. To date, few jurisdictions have actually published DeFi, with Norway and Norway being, or at least with Europe, being one of the first to do so. The ATO, the Australian Tax Office, has actually put out some comments, but we've also got this other complexity with the way that the industry gets presented to tax administrations and to regulators. So we talk about DeFi, but DeFi is a complex topic. It isn't just one thing, and that single term doesn't cover the broad range of things that it does, nor does it actually describe the different ways that it seeks to achieve those outcomes. And that's incredibly important from a legal legislative perspective. It also makes it really hard for us to actually provide guidance, should we say, on DeFi, because again, it's so wide, it's so broad, and it's changing all the time. So what we will be doing is separating out the different aspects to consider each in turn, starting with lending, for example, and returns from loans. And from that, we will be looking to get that out in the next few months. That is the aim. We've been working hard since the beginning of the year trying to follow this through. But I have to say, each time that we develop a position, something slightly different comes up. So if we look at Uniswap version 1, 2, and then Uniswap version 3, then bringing NFTs into the mix as well, it does start to become very, very difficult for us to give a settled position. So again, that consistency, that broad first principle approach is what we're going to be mainly looking at. And there's been a lot of interesting information from DeFi from a regulatory standpoint. The recent paper of this week from the World Economic Forum, the FATF, putting out more information around the lines of what's actually happened for the fifth money laundering directive principles. And hopefully we will start seeing a lot more reports from a tax perspective as well. And I think at that point, I better leave it there.
Well, thank you, Dean, for that overview of what our delegates need to consider. And it's very important to understand the challenges that policymakers from all areas, and you're an expert on taxation, is to find that balance regarding ensuring that the regulation doesn't have unintended consequences. And it is a fine line with revenue services, that you may create an unintended consequence where people then offshore their services, and that's not necessarily what we want. And you touched on first principles, and I know as we get further into the discussion into more technical areas, we'll pick this up as a common theme. But I just wanted to let folks know that we're starting to see jurisdictions, I think the US first with its 1040 documentation actually asks if the tax resident holds crypto assets, and we've just recently seen this in the UK, and I would assume that we'll see all other jurisdictions across the piece ask when completing self-assessment, for example, depending on the regime you're in, if you need to, whether you hold crypto assets. So just be mindful of that, folks. So do your reporting, make sure you know exactly what you're doing with your assets. So let's move the discussion on, and I'm going to pose my next question here to Doris. So based on your involvement, Doris, with the IBFD and the good work they do in regards addressing cross-border taxation issues, let's discuss how you see different jurisdictions' approaches to crypto taxations. You know, how are government and the industry addressing these challenges where we see perhaps crypto assets not given the same legal status or classification in these countries? You know, in your experience, are there arbitrage opportunities that both corporates and individuals alike may exploit? And how perhaps this is playing into a recent topical announcement from the G7, where ministers are backing global minimum rates of corporation tax of 15%. You know, how perhaps should countries look to address this in terms of the nuances that exist regarding the definition of crypto?
Yeah, so thank you, and congratulations to Dion. When I worked in the UK, really, HMRC, they work hard to give good guidance to taxpayers, and consequently, tax advisors have an easier time than they have worldwide in advising their clients. As Dion said, it is impossible to be ahead of the new technologies because every day something new comes up, and what we have to do is our best to give the best possible tax treatment and adequate advice. Here in Brazil, the Tax Revenue Service has issued guidance on crypto assets, but they've only done so for individuals. So since 2019, individuals they gave an express orientation for individuals to declare virtual currencies in the assets and rights part of the income tax return. This can be similar to a financial asset. So the revenue can interpret this as a financial asset here in Brazil. As you probably know, our coin is very volatile at the moment, but there is no exact quotation on how the cryptocurrency should be declared, on how the value should be, when purchased abroad, how it should be converted for local purposes. So basically general legislation is used. And what we say to taxpayers is you need to have the proper support documentation to prove the origin of the asset, right? And verify the transactions with competent and reputable documents. Mostly, we also have to present capital gain declaration in our income tax return. So once this is sold, the gains should be declared. From what I see, as Dion also mentioned, it's difficult to find a country that treats cryptocurrencies as money, right? As mentioned in the comments and as seen in recent reports, El Salvador has recently used it as a tender, has recently declared cryptocurrencies as a tender, but mostly as per OECD reports, the cryptocurrencies are not considered money. So from my international tax background, what can we see with this? We have issues with mismatches in declarations in the different countries, and consequently mismatches with taxation. Cross-border transactions, so if each country sees the asset differently, how can the taxpayer offset eventual withholding tax in one country with the other country? And my question would be, would the crypto assets be the new hybrids that BEPS have not yet caught on to, because these different domestic classifications lead to international issues, right? So for me, this would be the main issue. Also, I don't believe it's the issue of this panel, but central bank regulations. So for example, the Brazilian Central Bank does not see crypto assets as money, and they will not recognize such transactions as cash. However, these needs to be declared, and they need to follow our strict foreign exchange rules as well, if any money is being used. And the Securities Commission in 2018, they don't approve, they don't recognize also the transactions. So if you look at the bylaws of the exchanges, you see them as software companies, you see them as other types, but they're not declared as exactly as a cryptocurrency exchange. So moving on, and please correct me, Ian, if I'm missing something. So moving on to the 15% agreement of the G7 ministers, I think it's good that everyone's back together, because we saw in BEPS that the tax authorities saw that they need to collaborate with each other to guarantee their taxation, considering the new world of digitalization and how companies can move around easier. And not always this moving around, it means that the company wants to tax evade. It's just a smart new structures with the brave new world we're living in, right? But now they saw the difficulty of taxation. We know that BEPS Section 1 is difficult, it's being inconclusive. We have Pillar 1, Pillar 2, and now we have this 15% agreement of minimum taxation. In my view, there's still an issue on who is going to tax, right? We have the issue on the new technologies of the nexus for taxation. So the source and residence still has its challenges, because now we have, like the OECD discusses, we have the servers, we have all these international technologies, and the source and residence are now even more old-fashioned each day that they move. And also how, once we decide who is going to tax, how will this offset happen? Considering all the exemption and credit and Article 23 of treaties, considering everything that is going on, and the local classification of the new technologies, as Dion said, and as the last panel was discussing, not only the crypto assets, but the new NFTs, and we are buying art online for millions now. So all these issues, how can the taxpayer guarantee security, legal compliance, because there are taxpayers that want to follow, and from a global perspective, fair payment, right, for taxes. Another issue that I see is taxpayer privacy. So what is going to be shared amongst jurisdiction, for example, in CBC reportings? We have lots of trade secrets there. So until what point can this be shared? Can this be presented to everyone, right? Considering the importance of each business and of the new businesses that are coming up that Zoe, I know, has lots of experience treating and dealing with. And I believe another aspect that is going on a lot in Europe, ever since I live there as well, is the tax morale. So we have companies that are, I have a friend who's a tax director in a big oil company, and he's totally pro tax morale and sharing and showing everything that is going on. But of course, other kinds of new technologies that are being developed, sometimes the trade secret is also important. So we would like to share just with our tax authorities to show that we are in compliance with taxation, and perhaps not necessarily put it in a global level, because the new products are still being developed. So in short, I don't want to go too much over time, but I would say that the biggest challenges would be, exactly as Dion said, the classification And even though there may be domestic classifications, how can we deal with this in a global level? And to also do the exemption credit and the offset of the taxpayers who are being fair and who want to have pay taxes and move on with their activity globally. Classification, offset of taxes, trade secrets upon the growing information exchange, and also, of course, ensure country their fair level of taxes as well. As citizens, it is our interest that the revenue gains its fair amount of taxes as well to provide for the community, for the population. So I think everyone is on the same page, everyone wants the same thing, but the growing new technologies make this a challenge, right? As seen in Action 1 and as we are seeing now in our daily practice, independently of what it is, if it is as a tax advisor, in the tax revenue or anything else.
Thank you so much, Doris, for that interesting overview. And there has been and you touched on El Salvador, on the recent announcement of allowing for Bitcoin to be legal tender in that jurisdiction. And there's been a question from the audience. I'll get to that in a moment. I just wanted to bring Zoe in to sort of follow on with some of the interesting technical nuances that she's been dealing with. But just wanted to pick up on where we do see, if you like, a two-speed system across the globe, where you mentioned in Brazil, there's no guidance for corporations in terms of taxation. So that lack of clarity creates many issues, and we're seeing that in many areas. And as you also touched on, classifications, and we're still having discussions around the taxonomy of crypto assets, payment versus utility versus security versus non-fungible versus fungible. So it's, yeah, there's a lot to discuss. So let's ask our next question to Zoe, as a industry practitioner focusing on many global transactions in the blockchain space. Now, what's the most pressing challenges for the industry and the revenue services that you perhaps experience? Maybe focus on where you see in your day-to-day work friction or conflicts existing, and how should we perhaps look at these in terms of, say, first principles, as mentioned earlier?
Yeah, it's there's lots of ways to answer this question. I think let's start with first principles, and DeFi is a good example to be able to explain that. And then I do want to talk about ICOs and what I've been doing for the last 9 months, because I know, as Dion was saying earlier, ICOs were fashionable in 2017, but over the last 9 months, I've worked on 14 ICO transactions, and that has been the focus of my work. And there's a lot of tax complexity around that too. But just to follow on from the DeFi and the first principles comments, DeFi is still at early stages, and as we've already said, it's changing so quickly. And from the OECD's policy work on DeFi and its examinations of various jurisdictions, no one is releasing guidance on how DeFi should be treated. And I know Dion said the HMRC are working on that over the next few months. And it feels like that's right. It feels like it's not, that to release guidance now wouldn't be particularly helpful with the fast pace of change. And I think actually for now, jurisdictions have to apply first principles. So, let's say you have someone investing, putting up their tokens on a lending platform, and they receive tokens in return, but it's called interest. Is it actually interest? So you've got the source jurisdiction, so the jurisdiction which is paying the tokens, and let's not go into determination of source, because I think Doris has already covered that. But if the source jurisdiction classifies it as interest, then there could be withholding tax. If the recipient jurisdiction is classifying it as a capital gain, then you're going to have a mismatch with being able to credit the foreign tax with the country of residence tax. And so I think, as Dion said earlier, it is absolutely critical that people educate themselves. You have to be able to understand what's happening. You have to look at the transaction, look past the names like interest, and say what in substance, what's the essence of the transaction, and then apply normal tax principles. So I think at the moment, the challenges are around understanding the tax position and actually making sure you've reported your tax properly. And as Dion said, if you haven't, then there are, significant consequences. Not least, for example, in the UK, if you're dealing with an overseas jurisdiction, which this is often the case, you could be looking at tax penalties of 200% of the tax due. So not to mention reputational risk. And if you're a corporate and you're making those types of mistakes, then it could impact your being able to get regulatory approval and things like that. So education is the most important part. And in addition to that, underreporting, I think there's also risk of double taxation, as already mentioned. I do see, though, in the future that cryptocurrencies will be used as the new hybrid. I can see that being a possibility. And if you then take existing anti-hybrid legislation and try to apply that, I don't think it would be, particularly if you've got a jurisdiction that's treating it as a financial asset and another jurisdiction treating it as property, and the anti-avoidance rules in one jurisdiction apply only to financial assets, you could easily have some sort of mismatch. In terms of the stuff that I've been seeing, so over the last 9 months, one of the conflicts I wanted to highlight is that you have corporates in highly regulated jurisdictions or high tax jurisdictions, let's say in the UK, and they want to raise funds through an ICO. And to do that in the UK there would be regulatory uncertainty. So they make the decision to do this offshore, but that then brings a conflict by walking into a whole host of tax issues. So, and particularly around tax avoidance, so anti-tax avoidance rules. And the effects of those rules could be to deem income or profits of offshore entities back to the UK corporate or its UK resident shareholders. So you could go from having a 0 to, let's say, 17% corporate tax rate, because they're the ranges of the typical jurisdictions that ICOs are undertaken in, to potentially a 45% income tax rate in the UK, depending on how that offshore entity is structured. Or you could go from having, again, a 0 to 17% corporate tax rate to being subject to UK corporation tax at 19%, but no opportunity to deduct costs in the UK, and which is where most of the costs are incurred, because that's where the people are doing the technology development. So and what we see, I certainly come across companies that are, when an ICO is being undertaken, they're really at startup stage. And some of them will have funding because they've issued SAFs or they've done some equity funding. A lot of them don't have funding. A lot of them, and I do come across companies that have a shoestring budget and they haven't taken tax or legal advice. They've spoken to someone that they know who said, yes, set up a BVI subsidiary, or, oh, it's fine, you can just set up an Irish company and you can be the director. Or they've said set up an Irish company, but they haven't actually had a conversation about who should be the director. So they've gone offshore to mitigate or to secure regulatory certainty, but actually they've then brought it back in. So they've not only created tax issues, but they've created regulatory issues again. And then at the other end of the scale, you have the companies that can afford to take the advice and they understand the tax risks. But these anti-avoidance rules, which we have very well developed in the UK and particularly other high tax jurisdictions like Germany and other places in Europe, we have case law, we have guidance, but none of them apply or consider this sector. And so whilst I might advise a client how I think the anti-avoidance rules are going to apply, or if they're not going to apply, they are still so afraid, and particularly they're afraid of the attitude of the tax inspector that they would deal with. So in a lot of cases, they might have to report that they're claiming a defense to the rules, say the motive defense in their tax return. And their fear is that the tax inspector picks it up and says, well, this is crypto and there's obviously something wrong here, this is fraud, and so we're going to investigate. So they're afraid of long investigations. So they would take extraordinary measures to fall outside the rules and separate the ownership between the UK entity and the offshore entity. And they will look for unconnected parties to be the legal and beneficial owner and of the ICO proceeds of the offshore entity, and then look to bring it back into the UK through license agreements and service agreements over a number of years. And I think there are risks there.
So I just wanted to pick up on a couple of things there. That's super interesting, the groundbreaking work you're involved in with our industry, and we know that crypto is global in nature, and I'd just like to shout out to any listeners that if you're experiencing these similar challenges, because this is so new, we at Crypto UK want to get together to discuss this and work as a community to try and come up with best practice solutions for this. And it really highlights these issues around uncertainty, where regulatory uncertainty creates, again, these unintended consequences, where you say that because of the lack of clarity around ICOs and folks that want to raise capital, and the ICOs is a great way of capital formation, but not wanting to get in trouble with, say, the likes of the SEC in the US, for example, and perhaps having the ICO in a friendly jurisdiction in Switzerland, but not considering the tax. And now you've raised these funds and you built your DeFi platform, but now you're dealing with these other issues. It's the same in the UK in terms of getting a banking relationship for a crypto business has to offshore itself to obtain a relationship, and then when you apply into the FCA for the money laundering regime, it looks as if your legal structure it is laundering money, but you had no choice to get financial services. So it just is a good example. So thank you so much for that. And I think just for the sort of the last few moments here, if I bring in some interesting questions from the panel. So as I mentioned, El Salvador, and so perhaps I'll open this up to the panelists, and thank you for the question, Louise Lane. Now that El Salvador recognizes Bitcoin as legal tender, does that make Bitcoin a foreign currency in the UK? And if so, how would it affect the tax treatment? Maybe Dion, you want to have a stab at that one as a policy expert?
And thank you, Louise, for the question. And as Louise, as you would expect, I'm not going to make a policy statement on this forum as it currently stands. I do think the El Salvador announcement is interesting on a number of levels, but I'm always cautious with any announcement as to what actually happens. It's going back to, as Zoe was saying, we need to actually look at what this actually means. Are El Salvador actually doing it to the same level as the US dollar? Because if you note, the El Salvador comment was actually the accounting currency will still be the US dollar, it won't be BTC. So we're going to have to wait a bit of time to see what actually this means for the El Salvadorian position. I do think we always have to be careful, because there always tends to be a lot of hyperbole in this sector. We've seen, you mentioned the 1040 reporting in the US, and there was an update to the statement of assets in the UK, which is a form that gets done under particular circumstances and an investigation. And then that was reported in the press about a crackdown. It was a reporting requirement. Actually, it was no such thing. And we got a correction out there to say, we're not cracking down. So there always does tend to be an element that runs away here. And you have to wait for the dust to settle to actually see what does it mean. I would say, does it strictly change a UK analysis? No, not really, because even a foreign currency is still considered to be an asset. It's only sterling that's not actually considered to be an asset for capital gains purposes. So even if we look at that perspective, it's unlikely to make a change. But again, really do want to wait and see what truly falls out from this. But
yeah, what I would like to see is this going to be a domino effect. What other countries are going to start looking at any crypto asset as legal tender? So let's bring the discussion quickly back to ICOs. I know, Doris, if you want to talk about how Brazil and perhaps other areas of the Americas look at beneficial ownership.
Yes, so as Zoe was talking, I thought of an interesting case here in Brazil. So the first one about beneficial ownership, and the Brazilian Tax Revenue Service in 2019, they issued the guidance that all companies should present in their taxpayer registration number that they have here, they need to declare the beneficial owner, so up to the top, because the tax authorities now want to know where the actual top shareholder is, if they are in a blacklisted jurisdiction or a graylisted jurisdiction in Brazil. So this was a new compliance requirement here from 2018, 2019 onwards. And also the orientations for update of this declaration. Regarding ICOs, as Zoe said, here in Brazil, also the regulations date back to 2017. And specifically the Securities Commission, they gave something very open. They said that it may or be not under their control, right? So everything depends on the economic context of the issues and the rights granted to investors under the referred ICOs. So some operations may be under the authority of the Securities Commissions and others may not. They call attention to the risks of fraud and volatility. And also in 2017, there was a stop order for a company that offered an investment opportunity related to shares in a Bitcoin mining investment group. They said that this was an appeal to the public to enter into contracts that probably are not secure. And so they also mentioned in 2018 that the Bitcoins have an indefinite legal and economic nature, especially in the domestic market, differently from the revenue service. And this shows even an internal problem with the classification. So for the Securities Commission, they should not be qualified as financial assets. And I just saw here news that in late 2020, there was a fine for a company that was issuing crypto assets, and the Securities Commission understood that this issuance was irregular. So you see that even internally between central bank revenue, and I focused on revenue when I was speaking, and because of the tax issues and the tax guidance, but even internally here, there are some qualification issues between the different regulators.
Thank you.
I thought this was interesting to bring up. So
no, it's exactly what we want to highlight, explicit examples for the listeners as to where we see differences, challenges, and even clarity. Unfortunately, we've kind of run out of time, but just as an overview, I think if our attendees can take anything away, please educate yourself. If you're an individual investor, then please go to our website at cryptouk.io. We have a link to the HMRC guidance wherever you are in the world. Please do check your government websites. And to pick up on the first principles, if you get into the more technical aspects of corporate taxation, please do seek advice. And I like the idea that perhaps a crystal ball of we might see crypto be the new hybrid. Let's wait and see and get back on a panel in a few years to discuss that. So let me thank our wonderful panelists. Thank you so much for coming along today and speaking. Thank you to our hosts at Blockchain for Europe. Please do stay online on this virtual event. Our next panel is titled Headwinds in 2021, where a number of industry experts will provide their insights to what's in store for the future. Thank you so much.